Hey everyone! In the last video, I talked about why 99% of traders think the same way, and most end up losing, while only 1% of professional traders consistently succeed in the market. If you haven't seen it yet, you can check the card I placed in the top right corner of the screen. Today, we're going to dive deep into the world of the 1% of successful traders. I'll share how they think, how they make decisions, and most importantly, the strategies that help them consistently win in the market. Let's explore and uncover lessons you can apply to your own trading journey. Emotional mastery. Have you ever entered a trade, set your stop loss carefully, had a perfect entry and target, but just a few minutes later the market reverses, your heart races, your palms sweat, and you think, just a little longer, the price will come back. I'll move my stop loss a bit wider. If you have, you're falling into the emotional trap that most traders fall into. I have been there, and I know many other traders have too. At that moment, I thought I was smarter than the market, that I could control it with hope. The result? The trade went worse than expected. Losses doubled or tripled compared to the plan. Top traders, like Ed Seykota or Mark Minervini, do it differently. Once they enter a trade, the stop loss is set, and they never touch it, no matter how much the price fluctuates. They understand that stop loss is not the enemy, but the protector that keeps you alive in the market. Losses are not personal failures. In my early days, every stop loss felt like a personal failure. I was angry, frustrated, even thought trading wasn't for me. But observing successful traders, I saw that they never personalize losses. They treat every losing trade as the cost of learning, as payment for experience. Paul Tudor Jones once said, "You have to accept small losses to survive long term." When I applied this mindset, I no longer felt stressed over losses. Instead, I started asking myself, what caused this trade to go wrong? What lesson can I learn? Know your enemies. Greed and fear. In trading, the two most dangerous emotions are greed and fear. Fear. When the market moves against you, you want to cut losses immediately, even if the setup is still valid. You worry about losing all your money, about others judging you, about not being smart enough. Greed. When the market moves in your favor, you don't want to take profits, hoping the price will continue higher. You forget that the market can reverse at any moment. I have been controlled by these emotions countless times, and the result is always the same: losses, stress, and lost confidence. I realized that if I wanted to survive and succeed, I had to stand outside my emotions. Personal experience. The most painful loss. Once I entered a gold trade with a perfect setup. Entry, stop loss, target. Minutes later, the price dropped. My heart raced, and I started thinking, just move the stop loss a bit. It will come back. I moved it. The market kept moving against me, and I lost twice as much as planned. Looking back, I realized that fear and hope completely controlled me. If I had stuck to my loss would have been smaller, and I'd still have opportunities to trade later. The lesson: emotions kill traders faster than the market ever will. Top 1% traders? They set their stop loss and leave it. No matter how volatile the market, they follow the rules. They know that following the plan is more important than hoping the market will turn. FOMO and greed. The silent enemies. Have you ever seen the market moving in your favor, but you haven't entered yet, watching others profit, and FOMO kicks in? You hit buy or sell just because everyone else is winning. I've been there. The result? Continuous losses, increasing pressure, and mental chaos. Top 1% traders are different. They are patient and only enter trades when the setup perfectly matches their rules. They don't chase the market. They don't trade out of hope or FOMO. They know that one trade at the right time with the right setup is more valuable than 10 impulsive trades. Principles of emotional control from top traders. From personal experience and studying top traders, I learned these principles. 1. Recognize emotions before entering a trade. Are you deciding based on data or because of fear, hope, or FOMO? If it's emotion, stop immediately. 2. Absolute discipline with stop loss and target. Once set, never move them. Top traders always follow through, even during extreme volatility. 3. View losses as business costs. Do not personalize failure. Each losing trade is a lesson for long-term survival. 4. Prepare your process before the market opens. Setup, entry, stop loss, target, everything should be clear. When the market fluctuates, you act on the plan, not emotions. 5. Focus on the long-term journey, not short-term results. A bad trade today is irrelevant compared to following your plan and training your mind. 6. Practice emotional control daily. Journaling, deep breathing, meditation, reviewing. These habits turn emotions from an enemy into a tool. Real life example. Comparing ordinary traders and top 1%. Ordinary trader enters a trade, stop loss set, price dips slightly, moves stop loss wider, adds margin, hoping to recover. Result, large losses, mental chaos. Skilled trader enters a trade, stop loss set, target defined, no impulsive trades, no moving stop loss. Result, small loss, capital preserved, ready for the next opportunity. The difference isn't in technique, it's in psychology and discipline. Daily practice, journaling. Record trades, emotions during entry and exit, recognize negative emotional patterns. Deep breathing or meditation. Calm your mind before deciding to trade. Daily review. Observe emotions and actions, not just results. With consistent practice, emotions are no longer the enemy, but a tool to observe and act wisely. Core lessons. Recognize emotions before each decision. Follow stop loss and target strictly. Treat losses as learning costs. Prepare a clear plan before the market opens. Focus on the long-term journey, not short-term outcomes. Train emotional control daily. Applying these principles allows you to stand outside your emotions, see the market objectively, and make decisions with reason, not fear or greed. Exactly what the top 1% of successful traders do. Risk management, mindset on risk and capital management. In trading, I quickly realized that emotions are not the only thing you need to control. You can manage fear and greed, but if you handle risk poorly, you will not survive long enough to learn from the market. This is one of the most painful yet invaluable lessons I learned over 20 years on the floor. I still remember the day I opened my first account with the capital I had saved over years of work. I looked at the balance and thought, with this money, I'll turn it into a substantial profit within a few months. I placed large trades with high margin, thinking that just a few correct trades would make up for everything. The result? After a single volatile session, my account was wiped out. There was nothing left to learn from except a complete sense of failure. I had to sit down and ask myself, why didn't I survive long enough to have a second chance? From that moment, I learned that risk management is what determines a trader's survival, not technique or indicators. Even the greatest traders in the world, from Ray Dalio and Paul Tudor Jones to Mark Minervini, all emphasize this critical principle. Protecting capital is the #1 priority. The first principle I learned is to never risk too much capital on a single trade. Top 1% traders always follow the rule that each trade should risk only a small portion of total capital. A common guideline is 1 to 2% of your account per trade. When I started applying this, I realized that keeping risks small allows me to sit back and observe the market without psychological pressure. Before this, I used to place oversized trades, and after losing a few, my mind would collapse, and I could no longer make rational decisions. On the other hand, when I reduced each trade's risk to 1 or 2% of my capital, I could lose several trades in a row without feeling fear or panic. This is why top traders survive long-term and learn from their mistakes. Stop loss is not only a tool for managing emotions, it is also a tool for controlling risk. A top 1% trader never moves a stop loss in the hope of a rebound. They set it based on market structure, support and resistance levels, and average volatility. I remember a stock trade where I tried moving the stop loss when the price dropped, thinking it will come back. The result was that I lost twice as much. After that trade, I learned that moving stop losses is one of the most expensive mistakes amateur traders make. Skilled traders keep their stop loss fixed, and if the trade goes against them, they follow the plan and protect capital. Another principle I learned from Mark Minervini and Ed Seykota is risk-reward. Never trade if it isn't favorable. I used to enter trades because the setup looked good, but the risk compared to potential profit was too low. When the trade lost, I felt frustrated because I lost a lot while the potential gain was minimal. Top 1% traders always select trades where the potential profit is many times larger than the risk. They know that not every trade needs to win, but each winning trade can cover multiple losing trades. This is how they achieve consistent profitability and effective capital control. A major shift in my mindset was treating capital like a business budget, not play money. I began allocating capital to different strategies and markets, just like a company budgets for departments. For example, I might allocate 50% of my capital to swing stocks, 30% to short term forex, and 20% to small experimental trades. If one segment loses, the others continue operating, and the overall capital isn't destroyed. Top traders do the same. They never put all their capital into one trade or one market. Drawdown is a concept I used to hate the most. I would watch my account drop 10 to 15% and feel like giving up. But top 1% traders view drawdowns differently. They accept them, but control them. They set a maximum drawdown limit, say 10 to 15%, and when it is reached, they either stop trading or reduce risk to protect capital. I applied this principle and realized that if you refuse to accept drawdown but still try to recover quickly, you will lose even more. I also learned that diversification is critical for survival. I once tried focusing all my capital on a hot stock, thinking it would double my account quickly. The result was a heavy loss when the stock reversed. Skilled traders diversify across markets, strategies, and timeframes. This doesn't prevent losses, but reduces the risk of account ruin and allows them to survive long term. Position sizing, the detailed technique of capital management, is another principle I learned from Ed Seykota and Mark Minervini. Bigger money does not automatically mean better trades. Position size must align with risk, market volatility, and the trader's psychology. I saw amateur traders taking oversized positions, and a few losses would break their minds. Conversely, when I calculated position sizing based on 1 to 2% of capital and average true range ATR, I could enter multiple trades without stress and maximize profits when the market moved in my favor. I remember one particular instance in the crypto market when volatility was extreme and prices moved more than 10% within a few hours. I saw many traders using excessive margin, trying to scalp quickly, and their accounts were wiped out. I applied position sizing, risk-reward analysis, and predetermined stop losses. The market moved against me a few times. I lost a few trades, but I still retained 90% of my capital. When the main trend emerged, I captured significant profits. That is the power of risk management. Top 1% traders survive because of this discipline, not because they guess right every time. Risk management also means knowing how to be patient and wait for the right opportunity. Top 1% traders don't trade constantly out of boredom or hope. They only participate when the setup is perfect, the risk is calculated, and the risk-reward ratio is attractive. I used to overtrade, feeling like I had to do something, resulting in impulsive trades and consecutive losses. When I learned to be patient, choose the right setups, and follow disciplined risk management, my results multiplied and psychological pressure dropped significantly. The core lessons about risk management I want to share are: never risk more than 1 to 2% of capital per trade. Keep stop loss fixed and targets reasonable. View losses as a cost, not a personal failure. Calculate position sizing based on capital, volatility, and psychology. Diversify your portfolio. Never put everything in one basket. Accept drawdowns, but control them. Only trade when risk-reward is favorable. Be patient and wait for the right opportunity. Avoid impulsive trades. Applying these principles, you will see that protecting capital is the key to survival. And only by surviving long-term can you learn, gain experience, and become a top 1% trader who consistently wins in the market. Advanced strategy and trade execution. Once you have learned to control your emotions and manage risk, the next step is understanding advanced strategy and trade execution. This is where many amateur traders fail because they may have great theory or indicators, but when applied in real markets, they consistently make mistakes. I spent many years in the market before realizing that success does not come from predicting every trade correctly, but from executing a tested strategy correctly and consistently. I still remember the first time I tried applying a breakout strategy on tech stocks. I drew trend lines, identified strong resistance levels, prepared my entry, stop loss, and target. When the market touched the breakout level, I hit the trade, my heart racing like the first time I stepped onto the floor. The result? The price reversed immediately after entry. I panicked and moved my stop loss, trying to hope the market would come back. I lost heavily. From that experience, I understood that execution matters far more than the strategy itself. Top 1% traders not only have good strategies, but they also execute with discipline and precision in every detail. Advanced strategy is not just about using indicators or patterns. It's about combining an understanding of market structure, crowd behavior, and risk management. I learned from Mark Minervini that setups must be based on major trends, momentum, and significant support resistance levels. Even with a perfect setup, if your execution is wrong, you will fail. Trade execution includes entering at the right moment, sizing correctly, placing stop loss appropriately, and following through with your target. This is a cycle that top traders repeat with iron discipline. One principle I learned from Ed Seykota is keeping strategies as simple as possible. I once experimented with countless indicators, combining Fibonacci, MACD, Bollinger Bands, and RSI on the same chart. The result? I was overwhelmed, staring at overlapping signals without knowing which to trust. When I simplified my strategy to focus on trend and momentum, I realized it was far more effective. Top traders don't complicate things unnecessarily. They do only what is essential and patiently wait for the right opportunity. Execution is also about timing and speed of reaction. I missed many trades because I entered too late or exited too early. Elite traders observe the market like a living pulse. They know when to act immediately and when to wait for further confirmation. I learned that the market is not for guessing. It is for responding correctly according to plan. That is why backtesting and forward testing strategies are crucial. Only when you know how to execute properly can you act confidently without emotional interference. I also learned that entry is not just a price point, but a synthesis of market context. A successful breakout trade is not only about price crossing resistance, it must also consider volume, momentum, and nearby support levels. I once entered a trade solely based on a price breakout, only to hit a fake out and lose. Since then, I always wait for confirmation, increasing volume, strong momentum, and intact support levels before entering. Top traders follow this principle to avoid market traps. Stop loss in advanced strategy is also different. It is not only about protecting capital, but also filtering out market noise. I learned from elite traders that stop loss should be set at key technical levels or average volatility, not too tight to be triggered by random fluctuation, but not too wide to exceed planned risk. When applied correctly, I realized that small losing trades actually filter out weak signals, and large winning trades become the real driver of long-term profits. Take profit is another crucial part of execution. I used to be greedy, holding trades too long, thinking the price will go further, only to lose gains when the market reversed. Top 1% traders often use partial exits or trailing stops to maximize profits during continued trends while protecting capital if the market turns. I learned to scale out of positions, set trailing stops based on ATR or technical levels, and saw a significant difference in strategy effectiveness. A less obvious but critical aspect is psychological execution. You may have a perfect strategy, but if your psychology is unstable, you will fail to execute correctly. I once panicked during extreme volatility, moving stop losses or exiting trades prematurely. When I trained my mind, learned to stay calm, and acted according to plan, I realized that strategy and psychological execution must align for long-term success. Top 1% traders remain calm, even when the market moves against them multiple times in a day. They understand that each trade is part of a long-term plan, not a personal event for impulsive reaction. Additionally, multi-time frame analysis is indispensable in advanced strategy. I once looked only at the 15-minute chart and entered a breakout trade without checking higher timeframes, only to face reversals on the daily chart. Top traders always check the long-term trend, confirm significant support resistance levels, and enter only when multiple timeframes are aligned. This reduces whipsaw risk and increases the probability of success. I also learned that risk-reward must be defined before entry. Never trade without knowing how much you are willing to lose and how much you can gain. I once entered trades blindly, hoping the price would move my way, only to lose more and experience higher stress. When I started defining risk-reward upfront and combining it with stop-loss and take profit, I noticed that controlling outcomes became systematic and sustainable. Top traders survive on this principle, not luck. Finally, an advanced strategy cannot be complete without a system of continuous review and learning. I document every trade, every action, every emotion and analyze results weekly. This allows me to recognize recurring mistakes, fine tune strategies, and improve execution. Top 1% traders do the same. They never get complacent. They continuously refine their process, turning experience into actionable data. The key lessons I derived from advanced strategy and trade execution are: execution discipline matters more than strategy. Keep strategies simple and clear. Timing and quick reactions are critical. Entry must be based on overall market context. Stop loss and take profit should optimize both technical and psychological factors. Psychological execution is essential. Multi-time frame analysis increases the probability of success. Define risk, reward before entry. Continuous review and improvement make the system stronger. By applying these principles, you will see that winning in the market is not about guessing correctly, but about a solid strategy combined with disciplined execution and proper psychological alignment. The very approach top 1% traders have used for decades to succeed consistently. Continuous growth and self-improvement. After mastering emotional control, risk management, and strategy execution, I realized that the most critical factor determining long-term progress and success is a mindset of continuous growth. The market never stops changing, and strategies that worked yesterday may become obsolete tomorrow. I learned that if you don't continuously learn, improve, and adapt, you will be left behind. In the early days, I often thought that learning enough theory and understanding indicators was sufficient. I felt confident, placed trades, and failed. I remember attending a seminar with a professional trader. The mentor said, "A successful trader never stops learning. The market changes every day, and the only way to survive is to continuously grow yourself." Those words resonated deeply. From that moment, I began a journey of constant skill improvement, market observation, data analysis, and mindset enhancement. One of the philosophies of top 1% traders that I adopted is learning from mistakes. Instead of seeing losses as failures, they view them as valuable data. I used to feel frustrated when trades lost, but when I shifted my perspective, I realized each losing trade was a lesson about the market, my psychology, and my execution. I started keeping detailed records of every trade: why I entered, why I exited, my emotions during the trade, and the outcome. After a few months, I had a rich data set that helped me recognize patterns, recurring errors, and ways to improve my strategy. Self-reflection is essential. I learned to ask myself questions like, did I follow the plan? Did emotions influence my decisions? Did I risk too much? Previously, I ignored these questions, and mistakes repeated. When I made a habit of self-reflection after every trading session, I noticed that I could identify errors earlier, adjust, and improve continuously. This mindset of never settling and always seeking to improve became a cornerstone of my growth. Continuous learning comes not only from failure, but also from success. I learned to analyze winning trades. Why did this trade succeed? Was it setup, timing, or luck? Top 1% traders always analyze their wins to replicate what works and eliminate chance. I began keeping a detailed journal of both wins and losses, creating a comprehensive learning system that improved my strategy over time. Another key aspect of continuous growth is seeking mentors and high-quality communities. I remember trading alone, reading books, experimenting, and often feeling lost with no guidance. When I found a skilled mentor who had experienced many market cycles, I gained insights that personal experience alone could not provide. Mentors help identify mistakes, shorten the learning curve, and impart philosophies that only top 1% traders apply. Adaptability is another critical element. I was comfortable trading stocks, but when I transitioned to forex or crypto, I failed multiple times. Successful traders, however, analyze, adapt, and optimize their strategies for each market, rather than rigidly applying a formula. I learned to observe the characteristics of each market: volatility, volume, crowd psychology, and then adjust my strategy accordingly. Continuous growth also requires managing expectations and practicing patience. I used to rush for quick profits, but top 1% traders know that success is a long-term process. They are not swayed by short-term gains or market hype. I learned to focus on the process, follow my plan, and accept that results accumulate over time, leading to sustainable success. Innovation and creativity are equally important. The market constantly changes, and today's winning strategy may fail next week. I learned to experiment with new ideas, test them through backtesting and forward testing, and only apply them when data proved effective. Top traders innovate, but always grounded in discipline and evidence, not emotion or luck. Self management beyond trading is also essential. Top traders maintain their health, mental clarity, and psychological stability. I once ignored my health, trading long hours under stress, leading to poor decision making. When I took care of my body and mind, I noticed improved focus, better market observation, and increased patience. This is part of a holistic growth mindset. Continuous learning also involves reading, market research, and staying updated on economic and financial knowledge. I spend hours each week analyzing data, reading reports, and learning from other traders. Top 1% traders understand that knowledge is power, and deep market understanding allows them to make more precise decisions without being swayed by the crowd. Finally, a mindset of continuous growth is humility and the willingness to learn at all times. I once overestimated my knowledge, thinking I knew enough, but repeated failures reminded me that the market is always larger than any individual. Top traders remain humble, willing to learn from the market, peers, and their own mistakes. They view each day as an opportunity to improve and never become complacent. The key lessons I have drawn about the mindset of continuous growth include learning from mistakes, self-reflection after every trade, analyzing success to replicate good practices, finding mentors and quality communities, adapting and optimizing strategies for different markets, managing expectations and practicing patience, innovating based on data and discipline, holistic self-management, continuously updating knowledge, staying humble and always willing to learn. Applying this mindset, you will see that trading is not just a skill, but a continuous journey of self-improvement, and this is how the top 1% of traders maintain long-term success in the market. Independent thinking and full responsibility. Once you have mastered emotional control, risk management, advanced strategy execution, and a mindset of continuous growth, another factor that determines long-term trading success is independent thinking and the ability to take full responsibility for every decision. Over more than 20 years in the market, I realized that average traders constantly seek outside advice, blame the market, or hope that luck will help them succeed. In contrast, top 1% traders not only think independently, but also accept complete responsibility for their outcomes. My first personal experience that taught me this lesson was when I joined a trading room with several other traders. I would often follow the signals from the room leader without analyzing for myself. One day, the signal was wrong, and I lost big. At first, I blamed the leader and then the market itself. But after a few repetitions, I realized that placing the trade was my decision, and the loss was my responsibility, not anyone else's. When I started fully owning my decisions, I began analyzing the market independently, trusting my judgment, and my results started improving significantly. Independent thinking means the ability to make decisions based on data, observation, and logic, rather than being swayed by the crowd or noisy information. I have seen traders get caught up in crowd psychology when a stock skyrockets, buying without considering the longer-term trend, stop loss, or risk-reward ratio. The outcome? Repeated losses. Top traders, however, analyze from multiple perspectives, define their own setups, and only enter trades when all factors align with their plan, regardless of the noise around them. An essential part of independent thinking is the ability to analyze and evaluate information. The market is flooded with news, expert opinions, indicators, and other traders' predictions. I learned that if you always rely on others' viewpoints, you will never develop your own market insight. I began practicing independent analysis, reading charts, identifying trends, observing volume and price action, and evaluating risk-reward before entering any trade. Gradually, I became more confident and less influenced by external opinions. Taking full responsibility also involves acknowledging mistakes and continuously improving. I have seen many traders fail yet still blame the unfair market or a faulty system. I learned that top 1% traders always look inward first. If a trade loses, they ask, what did I do wrong? Did I follow my plan? Did I manage risk correctly? Admitting mistakes is not a weakness. It is the foundation for improvement. Applying this mindset, I turned every failure into a valuable learning opportunity instead of a source of frustration or diminished confidence. Another aspect of independent thinking is resisting hype and crowd mentality. I have witnessed the peak of a cryptocurrency hype, with everyone shouting to buy. I stayed out, analyzed the chart, volume, and key technical levels. When the hype collapsed, many traders suffered heavy losses, while I only experienced minimal impact from a few small test trades. This clearly shows that independent thinking helps you avoid market traps, stick to your principles, and protect your capital. Full responsibility also means taking proactive control of your capital and strategy. In the past, I would wait for the market or hope for luck to succeed. Later, I learned to set my own goals, define risk, place stop loss, and take profit orders, and accept the outcome, win or lose. When you fully own your trades, you act proactively rather than reactively, relying on external factors. This is a hallmark of top 1% traders. Another critical lesson is being confident but not arrogant. Independent thinking does not mean stubbornly ignoring valuable information. It is the ability to analyze, evaluate, and decide based on reasoning and data while accepting that you can be wrong. I learned to balance confidence and humility, confidently executing trades based on my analysis, but when results don't meet expectations, being willing to learn from mistakes. This mindset is how top traders sustain long-term success. Independent thinking also enhances market observation skills. When you are not chasing rumors or following others blindly, you learn to observe price, volume, crowd behavior, and support resistance levels objectively. I noticed that when independent thinking combines with solid technical analysis, the ability to identify optimal entry and exit points improves significantly. Another lesson from top traders is learning from your own experience. When you take full responsibility, every trade, whether winning or losing, becomes data for analysis. I started keeping detailed records of every decision: why I entered, stop loss placement, target, and my emotions. After a few months, I had a rich data set that allowed me to analyze patterns, recognize recurring errors, and refine my strategy. This is how top 1% traders continuously improve and boost performance. A key lesson is avoiding blame on circumstances or the market. I have heard many traders complain that the market is unfair, that news moves prices unpredictably, or that the exchange is rigged. I realized that accepting reality and taking full responsibility for every decision is the path to growth. Applying this mindset, I became more confident, made faster and more accurate decisions, and most importantly, I stopped depending on factors beyond my control. Independent thinking and full responsibility also foster long-term strategic thinking. Top 1% traders do not focus only on the next trade or buying right now. They focus on process, system, and long-term development. I began planning trades weekly, reviewing results monthly, and adjusting strategies based on real data. This is the mindset that any trader aiming for longevity must adopt. Finally, I learned that independent thinking and full responsibility create freedom in trading. When you are not influenced by the crowd and do not blame others, you trust your own decisions. You act based on analysis, strategy, and data, and you fully accept the results. This mindset is the difference between an average trader and a top 1% trader who consistently wins not because of luck, but because of their ability to think independently and take complete control of every decision. Key takeaways on independent thinking and full responsibility include: take full responsibility for all decisions. Think independently without following the crowd. Analyze and evaluate information objectively. Learn from both mistakes and successes. Be confident but humble. Observe the market objectively. Avoid blaming the market or others. Think strategically for the long term. And create freedom through complete control of your decisions. Applying this mindset, you will see that trading is not just a technical skill, but the ability to master yourself and make independent, responsible decisions. The very approach that top 1% traders have practiced for decades to maintain lasting success. Applying these mindsets, emotional mastery, risk management, advanced strategy and trade execution, continuous growth, and independent thinking with full responsibility, you begin to see that trading is not just about charts and indicators, but about mastering yourself, your decisions, and your approach to the market. Top 1% traders do not rely on luck or guesswork. They rely on discipline, consistent execution, a mindset of growth, and the courage to take full responsibility for every trade. If you want to truly elevate your trading journey and develop the mindset of a professional trader. Make sure to subscribe to Trading Mindset Lab. By joining our community, you'll get more insights, strategies, and real-world lessons that top traders use every day to succeed in the market. Remember, success in trading is a journey, and the right mindset will carry you further than any indicator ever could. Subscribe now to Trading Mindset Lab and take control of your trading future.